All right, good afternoon, everyone. I want to welcome everyone and thank you for joining us for today's Postmedia Pension Merger webinar for defined benefit plan members. My name is Steve Hyland, and I will be the moderator for today's session. What I'm going to do right now, I am going to pass it over to Adam Carpenter, who'd like to say a few words.
Hi, it's Adam Carpenter here. I'm a Vice President of Finance with Postmedia, and I've been working on the CAAT merger. I just wanted to welcome everyone today to the session regarding the proposed merger between Postmedia's defined benefit plans and the CAAT pension plan. Over the last few years, the company has been looking at different options to provide sustainable pension benefits to our employees, and we believe that this proposed merger will provide everyone with a secure and stable retirement benefit. Each of you on the line should have received the merger proposal in the mail, which describes the member consent process that we need to complete prior to July 1, 2019. And then subject to member consent and regulatory approval, your earned benefit from your Postmedia plan will be transferred to the CAAT pension plan. And then the merger will also enable Postmedia to continue to provide defined benefit pension coverage for all of our employees. So we believe that the merger with the CAAT pension plan would be a positive development for the company and plan members, but ultimately it is you members who have to decide and vote in favor of the merger for it to proceed. So make sure to listen carefully and get any of your questions answered today, and I'm going to pass it back to Steve so we can start the presentation. Thanks, Steve.
All right, thank you very much, Adam. And now what I'm going to do, I'm simply going to pass it back to our host, Jeff Kissack, to start today's webinar.
Thank you, Steve, and welcome everyone to today's webinar. Let's jump right into it. This session is intended for active members participating in Postmedia's defined benefit pension plans. So there will be separate webinars for inactive members. By that I mean retirees and individuals with deferred vested pensions. Those webinars will be on April 12th and May 1st. And we'll also be hosting separate webinars for those that are currently accruing defined contribution pension plans, defined contribution benefits in a Postmedia pension plan. And the webinar for defined contribution members will be on May 2nd and June 25th. So quickly, what we're going to cover today, well, I thought I'd start off by talking about why we're doing this, what's in it for you, what's in it for Postmedia, and what's in it for CAAT. Then we'll touch on an overview of the merger process and what you need to know about the merger. Then I'll give you some background on the CAAT pension plan and the DBplus plan design within the CAAT pension plan. That DBplus plan design is the one that Postmedia employees will be joining. We'll talk about the contributions and what you and Postmedia will be contributing to DBplus, and then we'll go through an example to kind of bring it all together and finish up with other features and next steps. So why merge plans? What's in it for you? Well, first you should know that the benefit you'll earn under a Postmedia plan will be replicated in and then backed by the CAAT pension plan. That gives you greater benefit security, and we'll talk about why that is in just a little bit. And as Adam said, you'll continue to earn a defined benefit pension. DBplus is a defined benefit format, just like the plan you're in now, but it also has other valuable features through your working lifetime, at retirement, and then after retirement. We'll talk all about those valuable features as we go through today's presentation. For Postmedia, they get stability and predictability of their contributions in financial reporting, which is a very valuable thing to employers in Canada these days. And they get to offer a defined benefit plan to all of their employees. For CAAT, what's in it for us? Well, first, it helps diversify our membership. Our pension plan was put in place to provide pension benefits for Ontario's college sector. But it will help us manage and de-risk our plan if we can grow that membership and involve other industries. So it's a diversification technique for the CAAT pension plan. Also, increasing our assets and liabilities gives us access to other investment options than we have currently. I mean, we are a large plan at $10.8 billion in assets, and so we have access to a great number of investment options already, but getting bigger gives us access to even more and helps reduce the fees. And that ties to the better economies of scale. There are certain costs of running a pension plan, and the bigger our asset base, the larger the amount that those fixed costs can be spread over. So it gives us the economies of scale as we grow through merger. So an overview of the merger process, and you see the timeline here now. We're just at the start of April, where member information packages have been sent out and sessions are starting to be held. And April 1st opens up a 90-day voting period. And that voting period is very important as to whether the merger goes through or not. And if it does go through, if the vote is successful, and we'll talk about what it takes for the vote to be successful in just a second, but if the vote is successful, active members like you will start contributing to and earning pensions under DBplus on July 1st of this year. And at that same date, you'll cease contributing to the Postmedia plan that you are currently contributing to. Throughout that voting period, and we'll see this at the end when we talk about next steps, we have a website available to you, online tools, and a call center to answer all your questions. This is not the only opportunity you'll have to get information and have your questions answered. We have these other tools available to you as well. And then, again, assuming the vote is successful, sometime mid-year next year, we expect the assets to come over into our plan from the Postmedia plans and be merged into the CAAT plan assets. The reason that part takes about a year to do is after the vote is successful, assuming it is, we will make a formal application to the pension regulators in Ontario to have the assets and liabilities of the Postmedia plans merged into the CAAT pension plan. That application will probably take the Ontario regulators 6 months to 9 months to review, so that's why there's a delay of having those past assets and liabilities come into our plan. But starting July 1st, 2019, you will start earning benefits under DBplus and stop earning benefits under your Postmedia plan. So what's required for the merger to proceed? Well, from the plan membership, we have two components. We need at least 2/3 of active defined benefit members, or the union representing them, to vote in favor of the merger. And you can see at the bottom that your union will vote on your behalf. But in addition to that, we need no more than 1/3 of inactive members, so those are the retirees, their surviving spouses, deferred pensioners, etc., to vote against the merger. If the inactive members don't vote, that is deemed to be a vote in favor of the merger. So they have to actively vote against, and we need less than 1/3 of them to vote against, whereas on the active membership, we need 2/3 of active members to vote in favor. And again, your union will vote on your behalf. From the regular requirements, things have been made a little bit more simple very recently. And all we'll need now, if the vote is successful from the membership, is the Ontario Superintendent of Pensions to approve the application to transfer assets and past liabilities. And we expect that to occur mid-2020. There was another requirement, but as you can see in the footnote there, that other requirement was eliminated a week or two ago. So you should have all, as Adam said off the top, received a package by now. And as an active member in a DB plan, your package would contain a letter from the Postmedia CFO, a letter from your union, in most cases, not all, information about the CAAT pension plan, information on how to estimate your pension, frequently asked questions, and a notice of amendment and other required disclosures that are required under regulation in Ontario. So, what you need to know about the merger. First, your Postmedia DB pension that you will earn up to July 1st, 2019 will be replicated and secured by CAAT. It will be paid in the same amount as what you earn up to July 1st, 2019, and under the same provisions as you have earned it under the Postmedia Plan. So the pension that you earn in your Postmedia Plan will not be reconfigured or otherwise changed into some CAAT pension. No. What you will get is the pension you earned under your Postmedia DB plan up to July 1st, 2019, and paid under those same terms and conditions. So how will that work? Well, basically, and the important point here is at the very top, your two pension pieces are added together to determine your total annual pension. We're going to determine your total pension at some point in the future when you come to retire or when you cease employment with Postmedia. We're going to determine it as two pieces. The part that you accrued under a Postmedia plan up until July 1st, 2019, and the part you earn in DBplus for your service on and after January 1st, 2019. And we'll talk through that as we go through. But let's look at it more pictorially. This slide shows how benefits earned up to July 1st, 2019 and benefits earned after are determined. And again, we will look at the two pieces separately and add them together. So in terms of the pension formula in the first line, your pension under the Postmedia plan will be determined at July 1st, 2019 based on the Postmedia plan formula that you are participating in. We've shown here the P&I retirement formula just as an example, and it's a 1.25% up to a final average YMPE and 1.75% for your average earnings above the average YMPE multiplied by your years of service. Beside that, on the right side, you'll see that after July 1st, 2019, you'll earn pensions under the DBplus formula and get those conditional AIW upgrades, and we'll talk more about that as we go through. But what if you want to retire early? Well, for your Postmedia portion, we'll look at the early retirement provisions in the Postmedia plan. And the reduction, if we look at P&I, the P&I plan as an example, the reduction is 4% per year from age 65 or age 62 with 10 years of service, if that happens earlier for you. And that reduction would be applied, in this case, to the P&I plan. If you belong to a different plan, the early retirement provision from that plan would be applied to your pension. On the right side, for everybody, your pension will be reduced 3% to 5% per year from age 65. The current reduction is 3% per year. And we'll talk about what could make it go up to 5% as we go through today. The eligibility service, and this would only really apply to the Postmedia early retirement provision. And you can see right above there, it says age 62 with 10 years of service. Well, let's say you're age 60 and you have 5 years of service at July 1st, 2019. Your service after July 1st, 2019, where you're earning pension under the DBplus formula, still will apply and be counted towards that 62 and 10 years of service. So in 3 or 4 years, when the person is now 62 with 10 years of service, he'll be able to retire and receive his Postmedia P&I pension without reduction. Now, the DBplus pension would still be reduced in accordance with the DBplus provisions, but you can start to see how we'll look at the two parts separately and add them together to get your whole pension. The pension form would be the same as it is currently for the Postmedia plan. P&I currently has a pension form of life with a 5-year guarantee. So what that means is when we calculate the pension under the pension formula, it's paid to the member for their lifetime with a guarantee of 60 monthly pension payments. If the member is retired and wants to have a joint and 60% survivor pension, for example, he'll have to take a smaller pension up front to provide that 60% survivor pension to his or her spouse following his death. On the DBplus side, if you're single, the pension is paid for your life with a 5-year guarantee. But if you're married, there's an automatic joint and 60% survivor form. There is no reduction. You don't have to take a reduction in your DBplus pension to provide that 60% survivor pension to your surviving spouse. That's built into our formula. So that's a nice thing. And finally, post-retirement inflation protection. Well, it depends on the Postmedia plan, but for most plans in Canada and the P&I plan in this example, there is no post-retirement inflation, no cost of living adjustments, if you will. For your DBplus pension that you'll earn after July 1st, 2019, DBplus offers a conditional post-retirement inflation protection of 75% of the change in the consumer price index. So if the CPI goes up 2%, you'll get 75% of that, or 1.5% as an increase in your pension. We'll talk more about that as we go through. The point to take from here is that your two pensions will be looked at separately. The P&I or Postmedia plan pension will stay in its same amount and be paid under the same terms and conditions as you have earned it up to July 1st, 2019. And the DBplus pension that you earn after that date will be paid under the terms and conditions of the DBplus plan provisions. So let's talk a little bit about the CAAT pension plan, and then we'll get into the actual provisions of the DBplus plan design within the CAAT pension plan. The CAAT pension plan, as I think I mentioned before, was put in place to provide pension to Ontario's college sector. It was established back in 1967, and it has grown significantly since then, and the goal is to provide lifetime pensions with great benefit security and conditional inflation enhancements, which we just talked about, and built-in survivor benefits. We're a multi-employer plan. We have 51 employers currently participating in our plan and growing for the reasons I talked about earlier. We have 50,000 members and growing that as well. We're a jointly sponsored pension plan, so let's just talk a little bit about what that means. I'm going to jump to this slide and then we'll go back. And you can see in the top sub-bullet there, our governance model is 50-50, meaning that half of our governing bodies represent employers and half of our governing bodies represent employees and their unions. And we find with this 50-50 governance model that you just get better decisions. If there's equal sharing in the decisions about costs and risks from employers and employees and their unions, you just get better decisions. Our plan is also about 50-50 cost sharing. That's why Postmedia will be contributing dollar for dollar to equal the amount that you contribute to our plan. We are firmly a believer in equal costs for both employers and employees. We're all about transparency as well and easy to understand communication. This is not the first, this is not the first webinar. This is not the only webinar. There will be many forms of communication available to you. And if you vote to merge with the CAAT plan, we will have ongoing communication sessions with you. We also have online tools and low operating costs, which means more of your contributions and the investment earnings thereon go towards paying benefits and securing your benefits. So let's go back up this slide and talk about just a little bit more about the CAAT pension plan. We have a staff of about 120 or so individuals that take care of the investments, the administration, the communications, risk management for our plan, and they are all aligned with one goal in mind: servicing plan members. We are not for-profit trust, and none of our positions are bonusable at the CAAT pension plan. That means that no one here is worrying about how can they maximize their own financial reward. It is all about providing secure pension benefits and servicing our members. We have $10.8 billion in assets, and we're currently 120% funded on a going concern basis. That means, said another way, for every $1 of benefits we have promised to pay from the plan, we have $1.20 backing that promise. And we currently have $2.6 billion of funding reserve, or surplus. In 2017, our net rate of return for the pension fund was 15.8%, and over the 5 years ending December 2017, the average annual rate of return was 11.4%. Those are outstanding numbers. So, with that foundation for the CAAT pension plan, let's move on and talk about the DBplus plan design that you will start participating in if the vote is successful. So what is DBplus? Well, it's a simplified defined benefit pension design, and it has fixed contribution rates for both you and Postmedia. The benefits earned under DBplus, the pension benefits earned, are based on a percentage of the contributions, and we'll see how that works in just a second, and the funded status of the plan. And we'll talk about what that means in just a second. But as an employee participating in DBplus, all you have to do is make contributions. And then you can enjoy watching your defined benefit pension accrue over your working lifetime. And the same for employers. They just make those matching contributions, and that's it for the employer. And they get to offer defined benefit pension plan to their employees. So it is a simple, worry-free way to add certainty and predictability to your pension income in retirement. And I'll turn to the bottom of this slide here. While you work and in retirement, your pension will grow with conditional pension enhancements. And we'll talk about just what that means in just a second. Other features of DBplus, and again, this is just kind of a highlight, and we'll go through a little bit more detail as we go through the presentation. You can retire as early as age 50 in DBplus, and Postmedia will be amending their plans to allow you to start your Postmedia pension as early as age 50. We have the 60% built-in survivor pension, and we'll have two types of benefit enhancements. While you're working, we will increase the pension that you earn with your contributions and Postmedia's contributions with the increase in the average industrial wage. The average industrial wage is a measure of how wages increase in Canada year over year. So as you earn your pension with your contributions and Postmedia's contributions, we're going to enhance it or increase that with a change in the average industrial wage. It's like getting compound interest in your bank account. And then after you retire, you will continue to receive increases to your pension. This time, they're tied to the Consumer Price Index. And I mentioned before that your pension will be increased each year based on 3/4 of the change in the Consumer Price Index year over year. And we also have the option to purchase additional pension, and we'll talk more about that another day. So before we get into the benefits, let's talk about the contributions that you and Postmedia will be making on your behalf. The contribution rate will increase relative to what you're currently contributing to your Postmedia plan. The amount of the increase will vary depending on which plan you're in. For some plans, it'll be a very small increase. For others, it'll be a bit larger. If we look at the P&I plan, members of that plan are currently contributing 2.5% of their earnings up to the YMPE, which in 2019 is $57,400. The YMPE is the year's maximum pensionable earnings under the Canada Pension Plan, and it's the threshold that you make CPP contributions up to. So again, the P&I members are contributing 2.5% of their earnings up to this YMPE, and then 5% of earnings in excess of the YMPE. If they join DBplus, they'll be contributing 5% of their earnings for all their earnings. And what that means is they'll be contributing an extra 2.5% of their earnings up to the YMPE because they're already contributing at 5% of their earnings in excess of the YMPE. And remember, your contributions are matched dollar for dollar by Postmedia. And just like your contributions to your Postmedia plan now, contributions to DBplus are tax deductible. And contributions will be directly linked to the benefits you earn. And we'll see that in the example that's coming up shortly. On this slide, we're trying to give you a feel for the difference in your take-home pay. So what we've got down the left side is our different earnings levels, starting at $40,000 in the top row and increasing by $10,000 until we get earnings levels of $100,000 in the bottom row. And we're showing there the Ontario marginal tax rates for 2019. And beside that, we have in the two columns what you are currently contributing on an after-tax basis to the Postmedia plan and how much that will go up. Now, these are weekly contribution rates. So for someone in the top row earning $40,000 and contributing under the Postmedia P&I plan, again, we'll use P&I for an example here, where they're contributing 2.5% below the YMPE and 5% above. On an after-tax basis, they are contributing $15 per week. And if they join DBplus, that will double. They will end up contributing an extra $15 per week. And that's because they are earning less than the YMPE. So all of their contribution rate will go from 2.5% up to 5%. But let's look at the bottom of the table, where someone's earning $100,000. Currently, they are contributing on an after-tax basis $39 per week. Now, that's only going to go up by another $16, and that's because only their contribution on their earnings below the YMPE will be increasing. They are already contributing at the 5% for their earnings above the YMPE. And remember, these are on an after-tax basis. The goal here is to try and give you a feel for how your take-home pay might change due to your contributions to DBplus. So how do we take those contributions and turn them into an amount of annual pension? Well, first, we can, in the top box here, we'll take the total contributions, that's the contributions that you make and Postmedia makes on your behalf, and multiply them by our annual pension factor, which is currently 8.5%. But remember, I talked about AIW, average industrial wage enhancements. So we're also going to grow your pension, as long as our funded ratio permits it, by the change in the AIW year over year. We're going to take the pension that you had earned to the end of the previous year and increase it with the AIW change year over year. So let's see how that works. Let's look at Philip. He's meant to be representative of the members in the Postmedia plan. He's age 55 and has pensionable earnings of $74,000 per year. And we've assumed for this example that his earnings would increase at 2% per year through to retirement. And Philip and Postmedia are both contributing at 5% of pay. That's the contribution rate that you will be coming into DBplus at. So let me draw your eyes to the top right slide, the top right corner of this slide. Philip is going to contribute in year one at 5% times his earnings of $74,000, and that equals $3,700. Postmedia is also going to contribute $3,700 for a total of $7,400 of contributions in year one. We multiply that by the 8.5% pension factor and come up with an annual amount of pension earned in year one of $629. Well, let's go back over to the bar on the far left, and you can see that $629 in year one. So now let's look at the second year. And the math is just the same, but remember, Philip's earnings have gone up by 2%. So in year two, his accrued pension is not $629, but rather $642. And that small increase is due to the assumed earnings escalation of 2% for Philip. So he earns a pension of $642 by his contributions and Postmedia's contributions in year two. And we stack on top of that the $629 that he'd earned in year one. And now on top of that, we add $14 of AIW enhancements. And for the AIW change, we're using 2.2%. The year-over-year increase in AIW is probably between 2% and 2.5%. We've assumed 2.2% for this example. So if you take $629 you'd earned to the end of the previous year and multiply that by 2.2%, you get that $14 of AIW increase. And I grant you, it starts small, but it builds. So by the end of the second year, he has $642 that he'd earned through his and Postmedia's contributions that year, the $629 that he'd earned at the end of last year, plus a $14 AIW enhancement. So his total pension is $1,285 by the end of the second year. Let's look to the third year. And again, his salary is assumed to go up another 2%. So he earns a base pension from his contributions and Postmedia's contributions in that year of $654. Stack on top of that the $1,285 he had at the end of the second year. And now that $1,285 pension is growing with the AIW increase of 2.2%. So the whole pension he had earned to the end of the second year gets increased with AIW. And that is $28 in this year. So it's doubled what it was in the previous year. And you add up all those three components, and by the end of the third year, he's got a pension of $1,967 per year, payable at age 65. But what if we look at the rest of his future lifetime? And on this slide, those first few years, 55, 56, 57, are down at the far left. And what we've done is assumed that he would work until age 65. What we're showing is the guaranteed base pension there, the bottom of the triangle, is the pension that he earns through his contributions and Postmedia's contributions. The AIW enhancements sitting on top, we're showing the cumulative total, and you can see how they really start to add up through Philip's working lifetime. And in fact, over the 10 years from age 55 to 65, AIW can increase his pension by 10% or so. And to be clear, even though the granting of the AIW enhancement is conditional upon our funded status remaining strong, once it is granted, it cannot be taken away. We've shown it separately here throughout his working lifetime just so you can see how they accumulate. But in reality, once that AIW enhancement is granted in any 1 year, it forms part of the guaranteed base pension on a go-forward basis. And finally, at the end, over the 10-year period, you can see that Philip will have contributed about $45,000 to DBplus, as will have Postmedia. They both have contributed the same amount. So now let's look at Philip's expected pension payments. So those first 10 years are now again kind of smushed to the left from 55 to 65. And then his pension is starting at age 65. And you can see clearly that the guaranteed lifetime pension starting at 65 includes not only the guaranteed base pension from his contributions, but the AIW increases as well. So that's his guaranteed lifetime pension, but it's also going to grow in retirement with conditional inflation enhancements. That's the 3/4 of the CPI that I talked about earlier. And we've shown them here in the light blue triangle sitting on top of the guaranteed lifetime pension. And so you can see that his pension starts at maybe a little over $9,000, but by the time he's reached age 90, his pension has grown to $13,500 or thereabouts through these conditional inflation enhancements. So a couple of things to mention here. You can see just how valuable the AIW enhancements can be through your working lifetime and how much additional pension the conditional inflation enhancements can bring you after retirement. So you can ask, how likely are these conditional AIW enhancements and conditional inflation enhancements going to be? Is there a good chance that these conditional enhancements will in fact be granted? And the answer is yes. We've done a number of modeling and projections out 20 years, and in a very high number of cases, 99% of the cases, the CAAT plan remains in surplus 20 years out. So there is a very high likelihood that these conditional enhancements, AIW and the CPI, will be granted. And if there's ever a year when our funded position drops down and we cannot grant these conditional inflation enhancements and conditional AIW enhancements, our plan has a catch-up provision so that when our plan returns to a strong financial position, any enhancement that was not granted will be made whole. And you can see here in the box on the left side, by age 70, Philip would have recovered his contributions made to DBplus. So in the first 5 years of retirement, Philip's total pension payments will have paid him back the contributions that he made for the 10 years of his working lifetime. And that's why DBplus has a guarantee of 5 years of payments to make sure that everybody gets back at least what they put into the plan, and hopefully much more. You can see on the other box that if we assume Philip lives to 90, which is a reasonable expectation of life for someone retiring at age 65, and then dies and a survivor pension is continuing, he could expect to receive almost 700% of his contributions in total pension payments to him and his surviving spouse. So let's talk about other features of DBplus. First, Philip, in the example we went through, we had Philip retiring at 65. What if you want to retire before 65? Well, I mentioned before that retirement is possible under DBplus as early as age 50. And if you choose to retire before age 65, we're going to apply an early retirement reduction factor. And that reduction factor is there to reflect the fact that you're starting your pension earlier, and therefore it's likely to be paid for a longer period of time. And right now, because our funded position is so strong, we're offering the smallest reduction that we have for DBplus, which is 3% per year below age 65. So if you wanted to retire at age 60, we will take the DBplus pension you've earned to that date and reduce it by 3% times 5 years below age 65, a 15% reduction would be applied. And some people might think that as a penalty for retiring early to have that early retirement reduction applied, but in fact, it's a subsidy. Because if we wanted to, actuarially or statistically reflect the reduction that should be applied to your pension to reflect the fact that it's going to be paid for a longer period of time, that reduction would be more like 6% per year. So yes, there's a reduction, but it's a smaller reduction than should be applied actuarially. If the funded position ever decreases in our plan, the reduction could go as high as 5%. Still better, still smaller than an actuarial reduction, but it can be as high as 5%. And I'll just mention that the early retirement reduction is applied only once at the time of your retirement. So if the funded position changes thereafter, there is no adjustment. The reduction is determined once at the time of your retirement. And just by comparison, the Canada Pension Plan allows you to retire as early as age 60 and draw your CPP pension, but they're going to apply a 7.2% per year reduction below age 65. So someone retiring and starting their CPP pension at age 60 would be subject to a 36% reduction in their CPP pension versus a 15% reduction in DBplus. And let me just also reiterate that this reduction would be applied to the DBplus pension you earn on and after July 1st, 2019. The early retirement reduction to be applied to your post-media pension earned up to that date would depend on the provision currently in place in your post-media plan. So what if you leave employment before retirement? Well, under the CAAT pension plan and DBplus, you have two options. First, you can leave your pension in the plan and will be responsible for it, and start at any time after age 50. If you leave your pension in the plan, it doesn't sit as a frozen crystallized amount. Again, we're going to grow it with conditional indexation through to the time that you start your pension. The increases are not tied to AIW, but rather 3/4 of the change in the CPI, just as retirement pensions are increased. So we will increase your pension at each year on a conditional basis from the date that you cease your employment with Postmedia up to the date that you want to start your pension. And again, you can start your pension anywhere between age 50 and 65. Here, because you're retiring from a terminated deferred status as opposed to an active employee status, the reduction for early retirement will be 5% per year before age 65, not 3%. If you don't want to leave your pension in the plan with us, you have the option, as you do under the Postmedia plans, of transferring the lump sum commuted value of your benefit out of the plan. And if you do that, then you are responsible for investing it and growing it through your investment earnings. The option to transfer out your lump sum is available, provided that you terminate before you become retirement eligible. And remember, retirement eligibility in our plan is age 50. But we also have a provision for a 2-year extension of membership. And that's common in multi-employer plans to make sure that your employment relationship truly is severed and you haven't stopped participating with Postmedia and started participating with another employer participating in our plan. So we have this 2-year extension of membership to make sure your employment relationship is truly severed. And if that 2-year extension of membership takes you past age 50, you will not have the lump sum option. So in fact, to be eligible for the lump sum option, you have to cease employment before age 48. One exception to this is if you are going to transfer your lump sum option not to your own locked-in RRSP, but instead to the pension plan of a new employer. If it's going to the pension plan of your new employer, and that employer agrees to accept the transfer, we will transfer the lump sum value of your pension to that new employer up to your age 65. So the age 48 restriction does not apply if you're transferring the lump sum to your new employer. So we've talked about early retirement, we've talked about leaving employment. What are the death benefits under DBplus? Well, let's look at them both pre-retirement and after retirement. So we'll look at the situation where you die prior to commencing your pension first. And we're going to split that into where you have a spouse and where you don't have a spouse. So on the left side, let's assume that you have passed away prior to retirement and you are survived by a spouse. Your spouse is entitled to a lump sum payment, and that lump sum payment is the commuted value, the same commuted value that will be paid to you on termination of employment. And your spouse can transfer that into an RRSP or take it as a taxable lump sum payment. If your spouse does not want to take the lump sum option, he or she may have it converted back into an immediate pension payable for their lifetime with a minimum of 60 payments. Or if your spouse does not want a pension starting right away, it can be deferred until age 65. So 3 options available to your spouse: lump sum, immediate pension, or deferred pension. If you don't have a spouse, the benefit is the lump sum payment to your designated beneficiary, which is why it's very important to designate a beneficiary, not just in DBplus, but in all the pension plans that you may be participating. If you have children under the age of 18, there is a children's survivor pension payable from DBplus. And those children under the age of 18 will split 50% of the pension you have earned until they reach age 18. So if you have one child, there'll be a children's survivor pension payable to them until they reach 18. If you have 2 or more children, that 50% survivor's pension for your children will be split equally among them. And then as each child reaches the age of 18, the survivor pension will be reapportioned among the younger children, until finally the youngest child is receiving the full 50% of your pension until they reach age 18. And if you have children under the age of 18, the total of the pension payments made to them will be subtracted from the lump sum commuted value paid to your designated beneficiary. And of course, you can name your children as your beneficiary if you want to. So what about the situation where you die after retirement? You have worked through to your retirement age, retired, and then pass away. Well, again, we'll look at the situation where you have a spouse and where you don't have a spouse. In the situation where you have a spouse, I mentioned before, we have a built-in 60% survivor pension. So your spouse will have that entitlement without any adjustment made to the pension that you're receiving during retirement. If, however, you decide at the time of retirement that a 60% pension continuing to your surviving spouse isn't quite enough, you can increase that up to 75%. That's the only other option we offer. And if you increase the survivor pension up to 75%, the amount of pension that you receive during your lifetime will be reduced slightly, 2 or 3%, say, to reflect the fact that a higher survivor pension will be paid to your surviving spouse on your death. On the death of the spouse, again, this is post-retirement death, but should your spouse also die, there is a pension that continues to your eligible children, if any, that are under the age of 18. And just like the pre-retirement death scenario, that pension stops when the children reach age 18. If you don't have a spouse and die after retirement, there is again, 60% of your pension will be paid to your eligible children, if any, until they reach age 18. But under both of that, and you can see this in the box at the bottom, there's a guarantee of 60 monthly payments of your pension to your spouse, your children, or your beneficiary. If you die after retirement without a spouse and without any children under the age of 18, and you have not yet received 60 monthly pension payments, the balance of those payments will be paid to your beneficiary in a lump sum. So, how can you get more information? We've pretty much covered all the main provisions of DBplus and the pension that you're going to start earning on July 1st, 2019, assuming a successful vote. But how can you get more information? Well, you can go to the website dbplus.ca/PNI and try the pension estimator. And don't forget the /PNI, because that's the website that has the estimator customized for Postmedia employees. And the pension that will be shown there, you can take your statement and populate the input field on the first page, and then play with different retirement ages, and it will show you the amount of pension you've earned under Postmedia and what you can expect to earn in the future under DBplus, combined and separately. Other sources, again, there's the website, dbplus.ca/PNI. We have a customer service call center where you can call 1-866-350-2228 or email any questions you have to postmedia@dbplus.ca. So you have lots of sources available to you to gather more information as we go through this process. Okay, well then, thank you everyone for your attention this afternoon. If you have any other questions, please avail yourselves of that toll-free number, the website, or email them. Thank you very much.